Hello there. My name is Davidson, and today I'm going to present a very compelling investment idea, which is AV Homes, with the ticker symbol AVHI. So first, who am I? I'm an individual investor from Israel. I've been practicing fundamental analysis and value investing for about 10 years now. In 2014, I started the Inspiration Fund, which is a model portfolio tracking my own personal funds. If you wish to learn more about me and my approach, check out my website at taldavidson.com. This is my first investment idea webcast ever, so I would like to have your feedback. Do write to me. Did you like the webcast? Was it helpful to you? Can I do anything to make it better? Please do provide me feedback. Two important disclaimers before we kick it off. First, I may make mistakes in the data presented or in my conclusions. You should always do your own due diligence before doing anything, nonetheless committing capital to an idea. Secondly, you should be aware that I'm not a registered investment advisor, nor a portfolio manager. I am in full compliance with the law, but you should in any case be aware that you act at your own risk. With that, let's kick it off. So, who are AV Homes? AV Homes is a home builder of active adult and primary residence communities in Florida, Arizona, and North Carolina. This means that they build neighborhoods both for older people and young families. They are split at about half and half between those two segments. They were incorporated in 1970 and now are the fifth largest home builder in Florida. They managed to survive through the real estate crisis and are only now returning to net profitability. The recent annual revenue is about a third of their peak revenue of $700 million in 2006. Here are a few photos to show you the really nice properties and communities that they are building. I truly think that this is gorgeous. Well, to sum up my investment thesis right from the start, I would say that AV Homes is set to create long-term value. Its stock price is significantly undervalued, and it has some short-term catalysts that once they work, will result in stock price appreciation. I really think we have a good opportunity here. First, once the new CEO Roger Craig joined AV Homes as CEO in December 2012, the company is taking a clear strategic path. It is aggressively growing revenue, both organically through development of its land assets and through acquisitions like the recent Royal Oak acquisition. Amid this enormous growth, it is also keeping SG&A constant, which is pretty amazing given the high growth rate. And it is strengthening the balance sheet, as I will show in a few minutes. AV Home is a kind of ignored company by the market, selling at a significantly lower book multiple than its peer group. The amazing thing is that it has written off most of its land and land asset inventory. To be exact, it has written off 76 of the amount on inventory it had in the books just before the real estate crisis started in 2007. It also holds approximately $130 million in net operating loss tax assets, which are not counted on the balance sheet. These tax assets are worth real money. They are not worthless. Once the company will make positive GAAP earnings before tax, they will come handy in offsetting this tax liability. The company is thus not expected to pay any taxes in the near future. So add the off-balance sheet the tax assets, to the book value of equity, and consider the book equity to what it is really worth today, not in the midst of the crisis, but today. and the economic value of stockholders' equity is probably significantly higher than what you see on the books. I will claim that the rebound in real estate, including the rebound for home builders, is not at all over. So there is the tailwind of a busted industry making its comeback. And an interesting thing about AV Homes is that I see catalysts developing over the next year or two, which will support the re-rating of the stock by investors. And as a result, stock price will appreciate. Those are the ones I listed here, like the unjustified low valuation versus peer group, the reversal of tax assets, return to profitability, and additional acquisitions. As with many of my investment ideas, the motto for this one is heads I win, tails I don't lose much, which I have borrowed from Monish Pabrai. If there wouldn't be a bear case, there wouldn't be an opportunity. Having a bear case is good. Howard Marks said that a value investor should always ask herself, why does this opportunity exist in the first place? What am I missing that the market knows? What do I know that the market is missing? So the bear case for real estate is this. Labor and materials costs are high. It hurts gross margins. Both Lennar and KB Home, which are two home builders, warned about lower gross margins in 2015. This created disappointment for investors and hurt the stock in a way. But really, it's pretty normal. As the macro conditions improve, home builders are busy again, and they want to build faster than the labor market grows. The labor market and raw materials market will eventually adapt to this renewed growth mode. I don't see something very alarming here. Also, investors may be concerned that the rebound in real estate is starting to level off. Zillow projects a mere 3 to 5% growth in 2015, and Realtor.com predicts 45% growth. This is lower than the growth rate in 2012, 2013, 2014. Well, I think that it is normal for growth to not go in a straight line. We have to adopt a longer term view, so I'm not overly concerned about this either. Lastly, lately there have been woes about the falling gas and oil prices, that they will result in massive job losses and as a result in falling demand for new homes. Yes, I think this is a concern, but not directly a concern to the markets that AV Home addresses, both geographically and demographically. Let's look at some optimistic views now. So, this graph shows the home sales trends in the last 20 years. SAAR means seasonally adjusted annual rate. We see that home sales are still far from their 2006 peak. The rate is still lower than even the normal rates of early 2000s. Sales still have room to grow as household formations have not slowed. Now this is an interesting graph. It presents the percentage of young people of ages of 18 to 34 who still live with their parents. See the strong effect of the crisis years. More and more young people are delaying their independence and staying with their folks to save the cost of buying or renting a house. This is a positive trend for home sellers. It means that eventually those young people will move out and support the demand for homes. Well, now for a table that I call a table which is worth 1,000 words. I compiled this table from the SEC filings. You can clearly see how the revenues slump during the crisis years and then start to rebound in 2011 and 2012. See the trend in gross margins and operating margins. Now, see what is going on since 2012. Revenue is picking up sharply since 2012. Gross profits turning into positive. SG&A stays constant, which is very nice. And operating profit turns positive, again, only in 2014. See also the trend in inventories, how it declined due to impairments and sales, and how it is growing again now. Now this is taken from the earning presentation of full year 2014. It shows the steep growth of recent years based on home closings. And the statement of cash flows also shows additional evidence to the trend of returning to profitability. You can see here that net cash used in operating activities is actually negative, but if you reverse the effect of land and other inventories, the outcome is positive. And cash that goes into developing land and inventories is really capex. Those are capital expenditures that are needed to sell homes in the future. Yet under GAAP, they are counted as operating activities. Therefore, the negative net cash used in operating activities rather than a positive figure. The balance sheet is strong, with net debt of only $100 million compared to equity of $287 million. I do expect net debt to increase, as I expect the company to use its cash for investments in land and for acquisitions. But what you can take from this slide is that debt is not too high, and overall the company seems prudent with how it manages its balance sheet. One thing we need to understand about AV Homes is that growth is not a bonus. It is not a nice to have, it's a necessity. The company just have high fixed costs, and unless revenues reach a certain level, the fixed costs are just going to eat up all the profits. Go back to the table which is worth 1,000 words. SG&A is about $16 million a year. AV Home needs a higher gross profit in order to offset this number and have a positive operating profit, as it started to have in 2014. Due to the high level of fixed costs or operating leverage, new revenue will flow almost directly to the bottom line, the net income. This net income will flow to increase book equity, and since home builders are often valued based on their equity multiples, it will potentially and hopefully result in a higher stock price. That's why growth is so important. A few words about management and key owners, or insiders of the company. CEO Roger Craig joined the company in December 2012. He is a respected professional in the home building industry, having served as the chief financial officer of Pulte Homes, which is one of the largest home builders in the United States. He served there for a period of 13 years. An interesting point about Roger Craig, he likes to switch industries every once in a while. He has been with food companies, with electronics companies, and now home building. I show the strategy he's leading, so by now you know that I think highly of this dude. Who owns the company? The largest holder, owning 42% of the shares, is a new limited partnership formed in 2013 called TPG Aviator. It is part of the TPG Capital Group, which manages $65 billion. Wow, they ought to be knowing what they're doing. TPG invested $135 million in June 13, and this gave the company enough cash both to repay its debt and invest for growth. The cool thing is that when I'm writing these lines, you can grab shares at less than what TPG Aviator paid for them, which is $14.65. Another notable owner is Osmium Partners. Osmium is a California-based hedge fund led by a person you see in the photo, John Lewis. Over the past year, I've been following Osmium, and I think they are doing an amazing job finding investment ideas and even taking activist positions in some companies, shaking up the boards. I have a couple of other stocks in common with Osmium. One is Rosetta Stone, which is just starting to work out, and the other one is Spark Networks, which hasn't worked out yet. You can check out Osmium's 13F to see their holdings. They are truly like-minded super investors that you may want to follow. Let's talk about the price and valuation now. See this stock price. Wow, it took a beating. Down all the way from $83 a share to 14 or 15 where it trades today. See the price to book ratio. It has been trading for less, but it's still cheap today. Once the net operating loss tax assets will be recognized as assets in the balance sheet, they will trade for even less, about 0.75x with today's prices. There's a famous saying that valuation is often its own catalyst. I think this applies in this case. Look at the price to book ratio of AVHI against its peer group. Except for KBH, which I think is cheap and worth a buy as well, other larger home builders are trading for far more. Sure, they are profitable, better capitalized, more diversified, but that's the direction AV Homes is going in. Sooner or later, it will be worth these multiples. Consider book value. It is more probable than not that the land and other inventory assets that AV Home keeps on its balance sheet are significantly undervalued. After all, they have written off about $300 million of inventory. I'd like to remind you guys that impairments go one way. Once the assets are written off, they cannot be undone, even when the real price, the economic price if you will, appreciates. So those assets were written off to fair value at the height of the crisis. And now, when home prices are rebounding, they must keep the same low value in the books. That's just how accounting rules work. What it means to you is that the stock is even cheaper than it looks. To understand the second catalyst, you have to go see what happened in January 2015 to another home builders, KB Home. KB Home had net operating loss tax assets, also known as carry forwards. What it means is that because it had lost money in previous years, it is allowed to offset future profits against those losses and pay less taxes. The thing is, the amount of taxes it can forego is not listed as an asset on the balance sheet, according to accounting rules, until the company starts to show sustainable profitability again. The act of recognizing the tax assets in the balance sheet is called reversal of deferred tax assets. This is what KB Home were able to do in their 10K published in January 2015, and I believe that AV Homes is next to do just that, maybe even as early as 2015. This will result in book equity rising and stock price to book falling as low as 0.75x according to prices today. Why is this important? Because the stock will become more likely to show up in value screens. More investors will notice it, and there's a higher chance that it will close its valuation gap and move up. Many investors have aversion to money-losing stocks. That's why when a company becomes profitable, it is a catalyst for price appreciation. On an operating profit basis, the company is already profitable. On a net income basis, it still isn't, but it's coming. You have a chance to buy the stock today before it gets net income positive and anyone or everyone notices it. The fourth catalyst I'd like to mention is M&A. The company is on a roll, buying smaller builders and projects, which move the needle in the right way. Recently, the company bought Royal Oak Homes. Next, I do believe that there are more acquisitions in the pipe. Making those acquisitions not only serve to grow revenues, they also make AV Homes stronger and provide publicity to its enormous value. It's not out of the question that AV Home itself will be bought out. This would serve as a nice exit for TPG, Osmium, and also outside shareholders. A private buyer is probably going to pay much more for the stock than what the company is trading for now. How much would a private investor pay? One possible scenario is this. The company continues the current trend and sells 85% of its inventory in each of the next 2 years. The contribution to operating profits will be about $60 million. If the company pays $5 million per year as interest on debt and no taxes due to the NOLs, this means that the book will grow from $280 million today to $340 million in 2016. Add to that unused tax assets of about $120 million, and you get a book of $460 million at the end of 2016. In my example here, it's $440 million, but it's not an exact science. Apply to that a 1.5x price to book multiple, which is still lower than the peer group multiple of 1.7x to 2.1x, and you will reach more than $30 a share, a double from today's prices. Of course, the actual numbers may be higher or lower. The important thing to remember is that even in the bear case, where the company merely breaks even, it can trade much lower than equity book value, which serves to provide a margin of safety. If the company falls even to 90% of book value, it will trade at $12 a share, which is only 20% lower than the prices today. So I think 100% upside with improbable chance of 20% downside, that's the business I'd like to be invested in. So what did we have so far? A rare opportunity to make a double in 2 to 3 years with a low improbable downside of up to 20%. Putting our second level thinking hat, attributed to Howard Marks, we must ask ourselves, how come this opportunity exists in the first place? I think that the market is ignoring this small cap that has a history of losses. I also think that as long as there is a bear case on the real estate recovery trend, such opportunities will exist. If everyone were bullish, there wouldn't be any upside left. I think that catalysts are going to play out in the next 2 or 3 years, and I am long the shares at $14, even $15, and even $16. This was my first investment idea webcast ever. Is it good? Does it suck? Tell me what you think, and how can I make future webcasts better? Send me an email or leave feedback at my website, taldavidson.com. Cheers, everyone.